traders, and welcome to a new day trading strategy video of mine. In today's video, we are going to be talking about statistical arbitrage. This is a type of arbitrage that is much simpler to use and simpler in theory as well than other arbitrage strategies that I've talked about, such as triangular or looking for coins at trading at parity. So what we're going to be looking at today is what is statistical arbitrage and an intro to that. What tools can we use to find highly correlated altcoins? And what are the three methods that we can use to trade these highly correlated altcoins? Statistical arbitrage is a fancy word, but really all it is a strategy that looks at two coins or two assets that are highly correlated historically. And we're using mean reversion on these two assets. So basically, if we have two coins that are trading and one spikes up, one spikes down, the coin that spikes up we would call overvalued, and the coin that spikes down we would call it undervalued. We would want to buy the undervalued coin and we would want to short the overvalued coin because we would expect that eventually the coins are eventually going to converge again back into their normal correlated relationship. The benefit of using this strategy is it is lower risk than traditional supply-demand trading, and any time that we're taking on less risk is going to be better for our profits, as less losses. Also, you don't have to use this method just for statistical arbitrage. You can also blend this kind of trading with traditional trading or even using indicators as well. Also, it is market neutral, meaning that it doesn't matter if many altcoins are not doing well or many altcoins are very bullish. It's going to be finding ways to make money regardless of what the market is doing, as long as there is volatility. So let's first take a look at the tool that I like to use to try to find highly correlated altcoins. So this site is enroid.com, and I'm on the correlations tab. So what I'm looking for here are two positive correlated coins, but I don't want to use two coins that have very different market caps. So I'm not really interested in looking at the relationship between such as Bitcoin and WTC. Bitcoin has a vastly greater market cap than WTC. What I'm more interested in is something like if I can sort through this, I can find the highly correlated coins. And I'm interested in looking for a coin that, so two coins that are, so just this, two coins that have a similar market cap, such as BTS and AE, Eternity. So let me click on BTS, because it seems to have some very good correlations, as you can see here. I'm just going to scroll down to see what the 7-day correlation index is. And yeah, we can see some really nice correlations in the last 7 days, 14, 30, and 45 of these few coins. Now, I'm not really interested in looking at BNB and its correlation to BTS because BNB is a much more highly traded coin and with a higher market cap than BTS. So I'm more interested in looking at the AE and IOST that have more similar market caps. So now we found a coin, BTS BTC. What I do is I like to put this on a line chart, and then I'm going to compare this coin to a highly correlated coin. So we saw that AE was highly correlated, so we're going to do AE BTC on the same exchange of Binance. And when that pops up, I'm going to want to color that a different line. So I'm going to make this a line, and I'm going to make it blue, so just these settings here. And we have it. We have two highly correlated altcoins on one chart. So really what we're looking for here is whenever we get massive divergence is when we can profit. And I'm going to be showing some examples of exactly how to do that. So traditional statistical arbitrage, like I had said, you just buy the undervalued and you short the overvalued. So an example of that would be, looking for one here. Yep, this would be one where you can see BTS BTC is in black and AE BTC is in blue. And if you notice here, BTS BTC went up about 1.6%. AE BTC did nothing, it moved flat. So we can see that there was divergence as this moved up and this did nothing. What you could do here is buy this coin and short this coin. And when you do that, you're hoping that the take profit that you set for one coin is going to be greater than the stop loss of the other coin. And I'm going to be showing you guys exactly what I mean by that. take profits must be larger than the stop losses with this model here. So this is something that I drew that I think is going to be helpful to look at. Imagine we have two coins, coin X and coin Y, and they're moving about the same rate. And then we see X just continues to move up, but coin Y actually just shoots down and starts trading around here. What we want to do is buy or go long the undervalued coin, that's clearly this coin here. And we're going to want to short the overvalued coin here. We're going to want to place a stop loss for the short, and we're going to want to place a stop loss for the long. And we're going to want our take profit to be about 2 to 3 to 1 of our stop loss. So if this is a -1 for a stop loss, I want about a profit of 3. So that would be 3 to 1, profit to loss. What that's going to give me is, let's say that this, convergence didn't happen, where when I shorted this and I bought this, I actually made double profit, where this one went up and this one went down, so I make a good amount of money off that. Let's say instead we buy this, we short this, but this coin just continues to move up, hits our stop loss. That's fine, because that would be a loss of -1. And if we buy this, and this coin actually does converges and moves with the altcoin, then what we're going to see is this would be a profit of +3. So a net profit of 2, because we would make 3 and we would lose 1 from this hitting that. The reason that we expect that a convergence at one rate is more likely is when you see this historical relationship like this, where a coin is just moving in the same exact direction and by the same exact degree, typically more often than not, whenever a coin makes a major move, it's going to be falling back into that correlation. So that doesn't necessarily mean that if this coin's moving up, then this coin will move up. What it might mean is that this rate is going to be trying to go down to a level where it previously was at with the rate before, like this. And this is why I put my take profit line about here, so that when both rates converge to that similar level that they were at before, you can take profit on both with that line. And if one hits your stop loss, the other one's probably going to make you a profit. If this one just kept going down, we would short this, and it would likely converge to this coin, and we would make a profit. You can do this on Poloniex, and you can do this on Bitfinex, because Poloniex does allow you to short altcoins, and Bitfinex allows you to short some altcoins as well. If you don't use Poloniex, which is available in the United States, and if you don't use Bitfinex, which is available in the non-United States, then you do have another option that does involve a little bit more risk, but it still can be profitable. And this is by just buying the undervalued coin. So what we're going to do here is long the undervalued coin, place a stop loss below a major low, and just take profit when both rates converge. So here's an example of what that would look like. And in black, we have BTS BTC, and in blue, we have ADX BTC. It's spelled ADEX for the altcoin name. Now what we see here is BTS BTC was moving down, where ADX BTC was just skyrocketing up. This would be a great spot to short this coin and a great spot to buy this coin, but let's say that we're using this method and we can't long one and short the other. Then what we're going to do here is just buy the undervalued coin. So what we're expecting is that because this coin is undervalued, it's going to want to move upward to a similar valuation of what it had before. Because you can notice here it's correlated, it's very well correlated here, and then we see that divergence. When we see that, we're expecting that there's a high probability that we're going to see that divergence vanish, and we're going to get convergence again, where they're moving together. And that is what did eventually happen, as you can see here with a bit of a lag. This one moved up, so this one moved up. This one moved up while this one was flat, so this one moved up as well. This one moved down, so this one moved down. Because they're highly correlated. And it's going to be hard to break a highly correlated coin, such as with ADX, I think right here, 98% correlated in the last 7 days, 96% correlated in the last 14 days. So these are good, these are high correlation rates that I am showing here. So we buy this and we take profit once we believe that the rate has converged. Once we believe that this rate has reached a point where it's not likely, there's no more divergence really available, then that's when we want to take profit. And we want to put our stop loss just below this low, around this range down here for about a 1% stop loss, potentially about a 4 3-4% take profit here. So that's just all you're going to be doing with buying undervalued coins. Now, the final strategy that we can do is we don't have to just use one coin. We don't just have to use 2 coins. We can actually use 3 pairs or even more by looking at correlations. This is going to give me more opportunities to trade and a higher probability because if many coins are moving in one direction and one coin hasn't moved at all or is moving in the opposite, I'm expecting that that coin is going to follow the herd and that coin is eventually going to move in the same direction, if they're highly correlated, of course. So that's what I'm really putting out here. And it doesn't have to be 3. It can be as many as you would like it to be. So in order to do this strategy, let's add IOST and let's add AE. So we already have AE BTC. Now I'm going to add IOST. And with IOST, I'm going to want to change the color and also make it into a line. So let's do line. Let's make it orange. Oh, that's a bad color. Let's make it red. Okay. So here we have IOST in red, we have AE in blue, and we have BTS in black. So what we're looking for is when 2 coins are moving in one direction and the third coin has not moved in that direction yet, we expect that that third coin is likely going to just start moving in that direction. So here's one example that is kind of interesting. I see that BTS at this point in time right here, BTS BTC isn't really doing anything. I'm seeing that AE BTC in blue, not really doing anything. They're both kind of just moving sideways. But I'm seeing heavy selling on IOST BTC. But the other coins that it's highly correlated to, I'm not seeing it doing what it would normally do. So what ended up happening here was we had heavy selling and we immediately rebound right back to the correlated value. So this is another way that you can play the market. Let's say one just tears downward and the other altcoins that you have set up here just aren't really doing much. It can be a little bit risky, but if you believe that that coin's going to revert back to the overall mean of its highly correlated altcoins with at least 96% correlation rate in the last 7 or 14 days, both should be at least 96%. If you see that that is occurring, then there is a good chance that it's just going to have to revert back to the mean. You can buy and make a nice profit with a stop loss that is completely reasonable. Looking for other opportunities here on the 1 minute so we can catch them very quick. The 5 minute may be best, but the 1 minute's going to allow us to catch these opportunities as quick as we possibly can. So here I think is a pretty golden opportunity as well. I'm seeing BTS BTC move up, and I'm seeing AE BTC move up at this point in time right here that my cursor is over. At this point in time, IOST BTC has done nothing really. It's kind of just moved flat while these coins have been bullish. Not surprisingly, this coin just spikes right upward, the red line. The red line here, IOST BTC just goes right upwards so that it can go right back to that correlated rate and hang out with its friends because it was kind of feeling lonely down here, so it jumped up here. And of course, you're also going to want to, it goes without saying, you're going to want to check the correlation between IOST and AE BTC because what I'm looking at here is BTS, AE, and IOST, but the correlation rate between IOST and AE would also need to be looked at. But if this one's 99% correlated and this one also is 99% correlated, there's a high probability that they already are correlated. But if you want absolute confirmation, you can just go back and you can go look at IOST and then look at how it sits with AE and make sure that they are correlated. And if you want to clutter your chart even more, you could even add more. We could try to add HSR because it has a similar, moderately similar market cap. So if I wanted to do that, I would type in HSR, BTC, and this is going to clutter the chart a lot. Maybe too much here. Maybe it just doesn't like HSR. We can find a different pair. REQ works as well. Okay, REQ BTC on Binance. And there it is. So when we're using multiple coins with statistical arbitrage, we want to find when 3 coins are doing something and 1 coin is not doing that. I'm going to make this guy, purple. So this one's like a mess, really, but we still see some really cool opportunities, such as here. REQ BTC, which is in purple, AE BTC and BTS BTC all went up. But you can see that IOST did nothing here at the same point that I had showed before. So we had triple convergence and one was doing nothing. This is just a great spot to buy and to get that profit. Looking for some other divergences here. And this really isn't necessary. You don't have to look at 4 coins at once. You know, I can get crazy with some of mine sometimes. But what we can also do is just look at, you know, like 1 and try to master that 1 correlation rate. Another tip that I would give with statistical arbitrage is it is important to be using correlations that are above 96%. But if you want a little bit of more of a gap where one coin makes a move and you're trying to buy the undervalued, you may want to look at a correlation rate a bit lower, such as 90 to 96%. But that might be more of an advanced play where you're looking for coins that are not as correlated so that you can take advantage of more divergences. But if this is your first time using statistical arbitrage, then I would recommend just sticking to the traditional method of buying the undervalued, shorting the overvalued. Because one issue that can happen when you just buy the undervalued and you don't use exact statistical arbitrage is, let's say that both rates are overall going down, but one rate goes down a lot quicker than the other, and you buy the undervalued coin, the coin that went down very quickly. Both rates may just continue to move down in the same kind of correlated fashion. So that could be an issue. But at the same time, we can see some pretty beautiful correlations here. Divergence, where this coin spiked up, this coin did not, so this coin spiked right back up, right back down. In this situation, this would not be a good time to use method 2 of buying the undervalued. This would be a beautiful situation to use method 1. I'm gonna want to short this and long this. Put my stop loss for this long, you know, like here. Put my stop loss for this short, like here. And then my long stop loss would likely be hit right here. But the good news is my short would be in very heavy profit. So this is a good opportunity when we get this massive divergence to use traditional statistical arbitrage and make a profit here as well. We get some divergence. If I had shorted this and longed this, they converge right back to the mean. And we can also see some situations where it may be good to use the second method that we had talked about. And I think I see a little bit of that here, where we can see that the BTS BTC moves up first. And at this point in time, this coin was here. And we can see that it continued to move up to follow this amount of rate of change. But again, I mean, it really does go without saying that traditional statistical arbitrage is the way to go. If you use Poloniex, if you use Bitfinex, that's going to probably be the stronger method here. But you totally can just look at coins that have similar market caps and try to just buy the undervalued, or the coin that's been flat while the other coin has been bullish. But do check the correlation rates, because some of these coins are going to be not great here, like DTR or some of these other like XMR or Strat. Not really coins that I'm interested in looking at for BTC correlation. And I would also recommend just looking for different kinds of setups. I can look for BTG even, BTG, BTC, because I know that trades on Bitfinex and Binance, I think. So you could do this on Bitfinex if you want to. And we could look for what is BTG, BTC most correlated to. So we see it's not really a beautiful correlation, but it's decently correlated to SALT. So if we want to pull this up on Bitfinex, we can do that. And let's pull up SALT on Bitfinex as well. SALT on Binance. LSK, I think, but that's not a great correlation. CVC, I don't know, maybe CVC is on Bitfinex? I guess not. I guess I'm proven wrong again. ARC or, yeah, LSK I think might work. Okay, Bitfinex does not offer a lot of coins, I guess. Basically what we're doing here is, let me actually just pull up the BTG, BTC on Binance instead of the one on Bitfinex, because we're going to be looking at this one in relation to SALT. So this one is not as correlated. It's 93%, I think I remember. But I think that there are some still really good opportunities here for doing statistical arbitrage, such as here, where this coin had moved up. This coin was moving up and up and up and up, and this one was just flat. So this coin just went to revert back to the mean of the correlation. You know, and here it kind of overstepped, so it went right back down. Here it's basically just following the path. You know, it's highly correlated here, very much correlated here. And then when we begin to see some divergence here, as this goes up and this goes down, this is just another spot we could just try to short this. And any part of this part here, we short this and we buy here. And we have our stop loss for this long probably hit about 1%. But the good thing is this this short with this coin is going to be you know, a pretty nice profit once you try to do that. So I think that's going to be it for this video, just an intro into statistical arbitrage and how you can use it. There are a lot of different ways that you can try to employ statistical arbitrage. I have found the best way to use coins that are similar in price and coins that are similar in their overall market cap. But you could experiment with this site with different kinds of correlations, but do be careful because that may carry more risk if they're not highly correlated. And if you have any questions on this or would like to talk further about it, you can reach out to me on my Patreon or on the Discord. Thank you for watching.